Good morning, and thank you for joining us. This is Digital Look TV in London. Joining us today is Bill Hubbard. He is Chief Economist at Markets.com. Bill, thank you very much for joining us.
And welcome back from vacation.
Thank you very much. How are yours?
Hey, come on, fantastic.
Splendid. Okay, on Monday, just to give a certain setting for the interview, Mohamed El-Arian from PIMCO wrote an article in the Financial Times and the FT, and he set out a long list of risk factors for the markets now in fall. He listed, amongst others, the U.S. fiscal cliff, the Fed tapering, the political turmoil in the Eurozone or political noise, negative noise coming out, the lack of a third arrow in Japan, and rather ominously, the risk of political tensions in the Middle East. Do you agree with him that these are large risk factors in total for the markets?
Well, I think one of the things, Alex, I think the thing that's very frustrating for some people, especially with, and I'm just looking like Syria, say in the last 10 days, okay? Mm-hmm. We all know that it's been a problem since the April, spring of 2 years ago. But I mean, at a point when the Federal Reserve started talking about tapering and being, quote, data dependent. Yes. We had the ECB start getting positive data dependent. We also have the Bank of England, even yesterday with Carney saying data dependent. Well, all of a sudden, the market started looking at the data. Well, has anybody looked at the data in the last 10 days or last week? Now, there's a question. Cruise missiles this afternoon or this, that, or the other. So all of a sudden, we've got another geopolitical risk, which is globally far more long-term, and it's having, again, a detrimental factor. What he said earlier, the fiscal cliff, we got over that. We got over the sequester. If we're concerned about something, 1st of November, probably we're looking at the debt ceiling, okay? Will that start to see people getting close to say, well, I really don't want to buy treasuries in August or September. Will they be paid for in October? Fortunately, October is a light month, so it's mostly a pay down.
Okay.
But then it's a situation where the risk factors are always there. They've just been enhanced now because of the geopolitical risk.
Okay, the geopolitical risk. Some people, I think, might be inclined to think that the problems in Syria, they will tend to blow over in short order. Do you agree with that?
No.
Or no? Okay.
Well, let's talk whether it's Syria, whether it's Libya, whether it's so many of these countries. I mean, and I'm not trying to be flippant about this, but these are problems that have been around for like 2,000 years. I mean, if you want to get, I was reading an editorial yesterday, there have been more people killed in Libya since the overthrow of the government. Yesterday there were 51 people killed in Baghdad. It was the rebels. But it's a question of who are the rebels, okay? So no, this will not blow over. Where I'm concerned about it is a simple fact is, look at that area, okay? You've got Iran. Iran is not North Korea. Iran says something. And one of the things, okay, on a smaller scale, yes, I don't know how far Dubai is from Damascus, but on Tuesday, Dubai Stock Exchange was off 7%. That's one heck of a move.
Massive drop.
And then again, what are we looking at? 3 months ago, gold, the rise in gold is over. We may never see $1,300 again. I mean, now it's $1,420, $1,450. Some people are now talking, if this continues, we could see gold back above $2,000. And also the simple fact is, what about oil? Oh, well, we have no problem with oil. I mean, oil's up like 20% in the past, like 6 weeks, okay? That's one heck of a move. Now, for me, we talk about oil, we look at it as a number. When was the last time you went to the petrol station? Petrol now 140, 141, 142, and it's only going to go higher if this price doesn't come down. So that will have an economic ramification for the man on the street.
Okay. I would like to know your point of view on one subject related to all of this. There was another article which I read recently in the press, and it had to do with the fact that the United States and, to a certain extent, the United Kingdom's allies in the Middle East are now each tending to go off in their own separate directions. Turkey one way, Egypt the other, Libya the other, Saudi Arabia in the other direction. Yes. In the medium term, geopolitically, that's incredibly unstable potentially?
Well, had we had this conversation yesterday at this time, all right, we had David Cameron, we're ready to strike Thursday, okay? We had the Arab League. Yes, it's Assad's problem and this, that, and the other. We support you 100%. 24 hours later, David Cameron says we will evaluate to see what the UN
Yes, what the
they're
results.
looking at, okay? Labor's against it. The Arab League saying, we will watch and wait, okay? So in 24 hours, we've gone from war starting now to maybe we'll wait till next weekend type thing. So it's a thing, and I think one of the things that they're now looking at, okay? In the U.S., right, whether you do YouGov, or 76% of the U.S. citizenry says no.
Right.
2 out of 3 Brits say no, no part, no this, that, or the other, okay? No cruise missiles, no this, that. And so politicians have got to listen to the people because where are we going to get the money from?
Indeed. It's very costly to go to war.
Yes, it is. And, you know, let's go to 1914. We're going to have the troops home by Christmas. Which Christmas, okay? We had 12 years in Vietnam. 54,000 people were killed, okay?
You were there in Vietnam.
Yes, I was, okay? How long have we been in Iraq? And what is it going to be, another 12, 18 months or something like that?
Yeah.
You know, and is it any safer? Is it any better? So no, you know, it's a situation where I hate to sound just crass about this, but let's back away, okay? We have domestic problems, whether it be here, whether it be in Spain, whether it be in the U.S. Let's take care of our own. But charity begins at home.
Indeed. Okay. Good point. All right. Going back, leaving the geopolitical backdrop, as scary and important as it is, and talking about U.S. economics. Fed tapering. We've had a very large backup in long-term bond yields. To what extent has it surprised the market? And how much further might the rise in U.S. 10-year treasuries have to go?
Well, I think one of the things is when it really first came out in May, going back to PIMCO. I mean, PIMCO felt that the 10-year at that time could go 2.25 to 2.35. There were other people who felt we could go to 3, which we got very close to 3. The reason why we're not seeing it go any higher is we're having treasuries buying on a safe haven basis. But one of the things to look at, this was a situation where you had people in the bond funds. Then people started selling bonds. If we can remember, okay, this time last week, the 10-year almost got to 3%.
Yes.
The first week in May, it was 150.
Outrageous.
So we've had one heck of a move back. So therefore, you are now seeing people maybe, if they're concerned about equities, maybe buying treasuries because it's giving them some kind of a yield here. But the point being is, I think in reference to what you said about the Fed, okay, the Fed has told us now in 3 consecutive meetings that, first of all, we all knew quantitative easing / tapering, whatever you want to call it, was going to end. Now they've sort of given us a possible date. I think the market was confused, maybe annoyed, maybe upset at the last minutes when they didn't say it was going to start on the 17th, 18th of September, which is the next meeting. So we went from tapering to octapering. Now, one of the things, and this goes back to where I think, and I know you haven't asked this question, but being an American, okay, and we all see what's happening in Indonesia, India, Brazil, pick a country, the currencies are getting clobbered. Now, one of the things that we have to look at, and we're talking about emerging markets. Now, when we had the first crisis in the States, which I remember, which was in South America in 83, 84.
Yes.
Now, emerging markets was only 15% of the global economy. At that time, the Federal Reserve, again, it's the U.S. Central Bank, they thought only as a domestic rather than global, and maybe I'm going to talk American, rather than there being numero uno, a most important bank, okay? And they started raising rates, and we had a problem there. Then, you may remember this, you were probably old enough for this, in October of 98, the Thai baht, same situation, okay? And the Russian ruble. Well, the only reason the Fed stepped in is slight problem with long-term capital management, okay? At that time, again, and this was at Jackson Hole, okay? When Greenspan said we're going to start dropping rates, which they did October, November of that year. But again, at that time, emerging markets had moved to 35%, okay? In today's market, okay, emerging markets is 50% of the global GDP. Also, the problem that we've been seeing with most of these currencies that are getting hit is because of their current account deficit. Well, if they've got a current account deficit, the people probably here unknowingly own Turkish lira, own Uzbekistan bonds in their global macro portfolio. So this will have a dramatic effect on what's happening here. And one of the things that's quite interesting, normally in these types of geopolitical risks, the dollar becomes a safe haven.
Right.
Well, the dollar hasn't been a safe haven in this, okay? It looks like it's been more oil and gold. So that's quite interesting. But my feeling is the Federal Reserve definitely should be, and this is a long weekend in the States, should be thinking about the global economy, okay? And the effect, as you just mentioned, the concept of tapering, what it done to the bond prices. Look where we are now in equity prices, okay?
Yes.
We're well off from the levels we saw, 2 months ago. And one of the things in reference to, again, in the U.S., as here in the UK, housing is an extremely important part, okay? For years, your house was your ATM machine. You just borrowed against the equity built
Right.
up. Well, now, as I mentioned about interest rates, in the past 6 weeks, mortgage rates have gone from 335 to 475 in the States, and they could go higher. Now, that is going to start, it's not having an effect yet, but the September, October, November data, pending house sales,
Right.
construction of this, that, and the other. Well, if it's going to cost me an extra, $50 a month or something, maybe I'll wait. House prices have gone up, mortgage prices have gone up, maybe, and we saw this in pending house sales yesterday.
Indeed. A bit weak.
Yes, not dramatically weak, but remember, this hasn't had the Syria effect yet.
Okay, I see. All right, moving from the U.S. over to Europe, to the United Kingdom. Yesterday, we had a speech from Governor Carney. He explained a little bit more the whole productivity puzzle and how that influences and shapes the MPC's opinions as far as monetary policy going forward. Do you agree with his view that QE is no longer needed and that unemployment will not rise until, or rather will not hit the 7% threshold until the end of 2016? So we'll have essentially flat rates for 3 years or not?
Well, let's go back. He can talk the talk. He clarified what he'd already said before, okay? But my question is, and I'm going to show a generation here. He can talk the talk, but can he walk the walk? And I think this is what we saw. And yesterday, if you were following sterling, okay?
Yes.
It dropped about an hour before the speech. It dropped almost 100 pips to 154.27, right?
Right.
The rumor was his speech had been leaked, okay? And the market was talking about the feeling it was going to be uber dovish. Hence the reason it dropped to 54.27. Then when they supposedly looked at it, it went back to 155 again. Okay,
I see.
And we closed to 155, sort of 25, and that's where we were
Around
trading
there.
this morning. Now, the key thing here is I have a difficult time with the unemployment, okay? As we saw in last month's U.S. unemployment, the rate dropped from 7.6 to 7.4.
Right.
Everybody said, oh, that's terrific, right? Well, if you look through it, no dramatic new jobs were created. It was my lot. The baby boomers, the OAPs who finally said, I'm going to stop stacking shelves at Walmart. I'm going to stop, selling Avon products. I'm going to get out of the labor market entirely. And hence, that's what the drop was. More than, 500,000 people, quote, said, enough is enough. I'm going to move to my condo in Florida and enjoy it. Now, the same thing could happen over here. And that's what the market's looking at. We feel that if he's talking about, and if he looks at the productivity, we could easily add, and we have added like 1.5 million jobs, okay, in the past 3 years, okay, in a recessionary economy. Well, if we even keep up that, we could easily be below 7%, hence the reason the futures market is talking. What do you mean mid-2016? The future, even after his speech yesterday, still implying rates will start going, the possibility of rates going up could be mid-2015. So again, we're listening to him, but as I say, talk the talk, but can he walk the walk? And even we already know, within the MPC, we had Charlie Bean's comments at Jackson Hole.
Yes.
We had Martin Wheel's comments last week saying, well, maybe we need another,
Indeed.
And we're talking about, remember, in 2011, Wheel voted 7 times to increase rates, okay? So we've seen that just change in 2 years. And as we all know, whether we like it or not, tomorrow is Friday. And the things are changing so quickly. And we talked about this before. How many, quote, cottage industries, how many qualified people were laid off? I don't care, just banking, IT, et cetera, senior executives with tremendous skills Okay, so maybe now they're sitting home and doing kitchen industries or pop-up dining, pop-up nightclubs, pop-up this, that, and the other, which are around for a while. And one of the things that came out last week or 2 weeks ago, I think, was like 1 million people on contracts in this country, sort of like as a pay-as-you-go. You know, if you don't work, but you're on a contract. All right. Now, are those people employed or not employed? Okay, I don't know. I don't know how the statistics office puts that down.
Okay.
So, but very easily we could get to 7% unemployment in this country within 2 years maximum.
Okay, so you are rather skeptical.
Yes, I am. I mean, that's why I not that I don't believe the data, but I'm not as rosy as he is, and hence the reason I have been a seller of sterling.
All right. Going on to the subject of sterling, I believe I've heard you in the past talk about the need for sterling to remain weak. Historically, however, looking at very long time series, sterling tends to be a rather very strong currency. The Bank of England, several years back, said that it was happy to see sterling weaken. Also, oil revenues have been falling, so I would imagine that would tend to weaken the currency. Going forward, is there a tendency for sterling to be strong again? What are the drivers of that historically?
Trade.
Trade.
Yeah.
Okay.
And I mean, one of the things here, and one of the things, even before Super Mario took over, Mr. Trichet's concern was he didn't want the euro at 135, 138, et cetera, because it was going to kill any external. And with us, our trade balance is getting better, but it's nowhere near what it needs to be for us to be self-supportive here. And as you just mentioned, with oil, we see what's happening, with the oil revenues.
Okay.
But the simple fact is, and I know everybody's been, yelling and screaming at the U.S., the Federal Reserve or the Treasury. I mean, one of the things that's kept the U.S. going in the past 5 years was a weaker dollar. Because the simple fact is U.S. exports are cheaper, okay? Because, and here, if you're not manufacturing, although our manufacturing has really started to go, especially in automobiles, all right? But who do almost 40% of our automobiles go to? They go to the Chinese, okay?
Right.
And I mean, the simple fact is, are you ready for this? We export more to Belgium than we do to Asia. Does that make any sense whatsoever?
Curious fact, definitely.
So, I mean, if we're going to talk about the global economy, but my feeling is that sterling should be closer to the 150 level.
Okay.
Again, as a balance.
So Carney ought to push back against any strength in sterling. That is a factor.
Yeah, but central banks don't do that. They let the market adjust to it. But I mean that is something you have to look at it. And I know that the Fed's been accused for a number of years. The only reason there was any recovery in the States was the weaker dollar. Oh no, we don't do that. We don't do that.
So they do that.
No, they can. Okay.
They can. Okay.
It's one of these things where, maybe I'll buy it later. Call me after the weekend type thing, though.
Okay.
But you can't manipulate your own currency. But I will have to say, there's only one central bank that can control the currency, and that is the Treasury.
The Treasury.
Yep.
Okay. Then, as a sort of summary of everything we've been talking about, risk preference going forward towards the end of the year. We'll see a dip now. It's just a correction, and then we'll see a recovery towards year end. Or is there a danger of the correction going even further?
Well, I think there's a danger of the correction going further. I think with what's happening now, as I mentioned earlier, I think the Fed should very, very, very diligently reconsider tapering from a global perspective rather than a domestic perspective. My call for next Friday's non-farm payrolls is 190,000. Still, that's not a bad number. I think the average has been 194. But the key is going to be do we see any change? Right now, my call is plus 190, no change in the unemployment rate at 7.4. But again, if we have more baby boomers leaving, so therefore we're not creating any new jobs, but we have people leaving. And you see, and we're the same age here in the UK, okay?
Yes.
So in the next 2 or 3 years, could we see a number of 60, 65 plus leaving it, okay? So I think the Fed should be reconsidering, I still see gold as a safe haven play.
All right.
One of the things that may help then the global equity markets is one of the laggards in most of the global equity markets have been mining shares, where they were the boomers for the last 12 years. Well, now, if gold 1450, 1475, silver at $30, platinum, palladium start to go up, then does that make it more profitable for mining? So therefore we could see a lift in some severely depressed. I mean, you've got some of these mining shares that are off 60, 65% so far this year. Well, could you then see the bottom fishes starting to look at that? That could help the equity markets. With oil, I think we will probably see a somewhat of a sell-off, but it's like anywhere else. Once they've got it high enough, you know, it's sort of like there's nothing more permanent than a temporary tax. And the simple fact is the oil companies will start making some money. They can sort of keep it up there, and if need be, they can say, well, you know, we keep it up because we're concerned about whether it's Syria, whether it's Lebanon, whether it's Iran, whether it's so and so. So they could keep that up. So therefore, I see geopolitical risk, but I think we may have to have the discussion this time next month, because none of the data that we will get for probably even the first half of September will be truly indicative of the concern about Syria, consumer sentiment, this, that, or the other, because you see all this data will have been collected prior, and even the non-farm payroll data will be collected prior to the recent blow up in Syria.
Interesting. Okay, then on that note, and hopefully you will want to join us again.
I will.
At the end of next month. I guess we'll have to wrap this up. Fortunately, it's all the time that we have for today. But Bill Hubbard, Chief Economist at Markets.com, thank you very much for your time. And that's all from us here at Digital Look for today. We hope to have you again next week.